The Coverdell Education Savings Account, called the Coverdell ESA for short, is a savings account created to incentivize saving for all stages of education from kindergarten to higher education. Its major benefit is that all contributions can grow and be distributed tax-free when used for qualified educational expenses. Coverdell ESAs can be created by family, friends, or the beneficiary themselves, as long as the beneficiary is younger than 18 years old. For those of you who are unfamiliar with the term, a beneficiary is the student using the money. Since 2012, contribution limits for this account are set to $2,000 per year per beneficiary. That means no matter how many accounts or how many different people make contributions for a single beneficiary, the total amount contributed in a given year cannot exceed $2,000. All contributions made in excess of $2,000 are charged a 6% excise tax. Additionally, contributors with a modified adjusted gross income, MAGI for short, above a threshold cannot contribute to a Coverdell account at all. In 2015, the MAGI limit is $110,000 as an individual taxpayer and $220,000 as a jointly filing married couple. These numbers can change yearly, so make sure to be up to date if you're planning on opening an account. Also, note that once a beneficiary turns 18, no more contributions can be made to their accounts. Since distributions are only tax-free when used for qualified education expenses, I'll describe what they are. Qualified expenses differ from students in K-12 and higher education. K-12 qualified expenses can include tuition, enrollment fees, academic tutoring, special needs services, courseware, room and board, uniforms, transportation, and supplementary items or services required by the school, as well the purchase of any technology including a computer or internet access. Higher education qualified expenses can include tuition, enrollment fees, courseware, computer equipment, and special needs services. In addition, room and board can be covered when paid directly to the school for a student enrolled half-time or more. Regarding financial aid, it is better for a parent to own the account, since schools expect only 5.6% of their assets to be contributed, whereas students are expected to contribute 20%. This means that if the account belongs to parents, there's a higher probability that the school will offer more financial aid for the beneficiary. Once the beneficiary turns 30, if the account's balance is not zero, they are given 30 days to roll over the account to another family member. If they do not, the money is distributed as taxable income to the beneficiary and subjected to an additional 10% tax as a penalty. Lastly, I want to differentiate the Coverdell from a 529 plan, since 529 plans are a popular alternative for education savings. Some unique positive qualities of 529 plans are that there is no yearly contribution limit, only a lifetime limit which should cover the entire cost of college. You can contribute regardless of the beneficiary's age, which may appeal to older students, and there is no MAGI limit for contributors. On the other hand, the funds cannot be used for K-12, and there are fewer investment options offered than the Coverdell ESA.